All right, get ready because we're doing a deep dive today into the world of Marsten Parker.
Marsten Parker.
Yeah, a name you might not know off the top of your head.
Right.
But this guy, let me tell you, is a legend in the making.
For sure.
He's one of those unknown market wizards, if you're familiar with Jack Schwager's book.
Oh, yeah.
By the same name.
Absolutely.
And for good reason. We're talking about somebody who has an average annual return of 20% over the past 20 years.
Incredible.
More than triple the S&P 500 over the same period.
Yeah. And what I think is so fascinating about him is how he got there.
Yeah.
You know, he's not a typical, like, Wall Street guy. He didn't go to, Harvard or Wharton. He didn't work at Goldman Sachs. He took a
completely different
path to get to this.
So let's unpack that a little, right? We're talking about a guy who started as a classically trained musician,
right,
a violinist,
yeah,
before becoming a computer programmer.
Yeah.
How do you go from composing concertos to, crushing it in the stock market?
Well, and that's, I think, what's so great about Parker's story is that it really shows you that you can come from anywhere and be a successful trader or investor.
Yeah.
So, his journey really begins at Manhattan College in New York City, where he was studying to be a violinist. But along the way, he realized that technology was really his passion.
So he traded in the violin for a computer keyboard, huh?
Yeah, basically. Yeah, he got a few different programming jobs.
That's a pretty big shift.
It is a big shift, yeah. But I think what really changed everything was his involvement with a company called Segway Software and their IPO.
Okay.
And that IPO made him essentially a millionaire overnight.
Wow.
And it kind of, it brought him into this world.
Exposed him to it.
Of the stock market.
Yeah. And this is where things start to get interesting, right? He doesn't just sort of ride this wave of newfound wealth.
Right.
He actually becomes very curious about trading.
Yeah.
Devours all this literature.
Yeah.
Is really looking for an edge, any kind of edge.
Yeah, he was reading, all these books.
Yeah.
Scouring the internet, message boards, everything he could find.
Yeah.
And that's how he stumbled across a guy named Gary Smith.
Okay, yeah.
And Gary Smith had this trading methodology that Parker read about in a column on thestreet.com.
Okay.
And what really intrigued him was the systematic nature of it.
Yeah.
Gary Smith's methodology really focused on these high volume breakouts and breakdowns.
Okay.
Which resonated with Parker's analytical mind.
But he wasn't one to just blindly follow anybody's advice.
No, he was very skeptical.
Yeah.
And I think rightfully so.
So he decided to put it to the test, right? He wanted data, he wanted evidence, he wanted to see if it actually worked.
Exactly. Yeah, he wasn't satisfied with just anecdotal evidence or listening to, some guru tell him this is going to make him rich. He wanted cold, hard data.
This is where the computer programmer really comes in handy.
Exactly. Yeah, so he started backtesting this methodology, really meticulously looking at all the historical charts, crunching numbers to see, does this thing really hold up?
And this is when he has his aha moment.
It does. Yeah, he made this incredible discovery.
Where he finds that the larger a stock's initial drop, the more likely it was to continue falling.
Right, yeah.
Which is kind of counterintuitive.
You would think it'd be the opposite, right?
Yeah.
But that's not what the data showed.
It's almost like a snowball effect.
It is, and it has to do with I think principles from behavioral finance.
Right.
When a stock experiences that big drop, it really triggers this cascade of selling. Fear takes over, everybody's rushing for the exits.
Makes sense.
And that selling just pushes the price down even further.
So how did this insight shape his trading? Did he just start blindly following this methodology at that point?
No, I think what it did was it really sparked this passion in him to develop his own systematic trading system. That incorporated the principles of Gary Smith, but it was really tailored to his own risk tolerance.
So not just a follower, but an innovator.
Exactly. He was always looking to refine and improve.
And again, this is where the programming really helps, right?
Absolutely, yeah.
Because he's not just manually going through charts, he's literally building the software.
Building software.
The algorithm.
To scan the market, identify opportunities, and even execute the trades based on his rules.
So he's building this trading machine, essentially.
Yeah, it's like this automated system.
But did it work perfectly right out of the gate? Even the most sophisticated machine needs fine-tuning.
Yeah, so his initial system really focused on those high volume breakouts
Right.
and breakdowns that we talked about, using daily volume as a key indicator to find his trades.
Okay.
And it performed well for a while,
Okay.
but like any system, it had limitations.
Yeah.
And in 2001, he actually faced a pretty significant drawdown,
Mm.
which forced him to reevaluate.
And that's important for our viewers to understand,
Absolutely.
right? That even the best traders experience drawdowns.
It's part of the game.
Right. It's not about avoiding them. It's about managing them effectively.
Right, exactly. It's all about risk management.
So Parker didn't just give up after this drawdown.
No, he used it as a learning experience.
Mm.
He went back, really scrutinized his trading records,
Yeah.
trying to understand, what went wrong,
Yeah.
and how could he make the system better.
So what did he discover?
So he realized that the system was generating valid trading signals,
Okay.
but his execution was lagging.
Yeah.
The signals were fleeting.
So he was missing the boat because he wasn't fast enough.
Right.
Yeah.
He needed to be able to react quicker.
Got it.
And so that led him to a pretty major system overhaul.
Okay.
He shifted from end-of-day executions to intraday executions.
Which is a whole nother world.
It is. It's a whole nother ball game.
Yeah.
Much faster paced, much more demanding.
So much more challenging.
yeah.
Okay, so this is where we're going to pick it up
Right.
in the next part of our deep dive, right?
Sounds good.
We're going to explore how he adapted to this world,
Yeah.
this faster-paced world of intraday trading, and how that really propelled him to even greater success.
Yeah, the most profitable period of his career.
Awesome. We'll be right back.
Welcome back. When we left off last time, Parker was really at a crossroads in his trading journey.
Mm-hmm.
He had made this big decision to switch from end-of-day executions to the world of intraday trading.
Which wasn't just a minor tweak, right?
No, this was a major overhaul.
This was a complete shift in his trading style.
Right, completely different.
Requiring a whole new skill set, a whole new technology, probably.
And this was a big challenge for Parker.
Yeah.
Because, he was still primarily a programmer,
Right.
not a seasoned floor trader used to, the fast-paced,
Right.
hectic nature of the trading pits.
So how did he bridge that gap? Did he, hire a bunch of traders, or did he, become a day trading guru overnight?
No, he didn't. What he did was he leaned into what he knew best, which was technology.
Makes sense?
He started using real-time data feeds.
Okay.
And he developed these sophisticated algorithms that could analyze market data in real time,
Okay.
identify his system's signals, and actually execute trades automatically, all within milliseconds.
Wow. So this really is building the ultimate trading machine.
It really is. It's this idea of, removing the human element, the
Yeah.
emotion,
Yeah.
and letting the machine take over.
So did it work? Did this solve the execution problem?
It did. It was a resounding success. And by automating his trading, Parker completely eliminated those delays
Yeah.
and emotional biases that had plagued his execution before. So he was now capturing these fleeting intraday opportunities
That's incredible.
that he had been missing before.
So what kind of results did he see after making this shift? This sounds like it was a game changer.
Yeah, so the impact was dramatic. His revised system with these new intraday execution capabilities generated incredible returns.
Right.
And in fact, the period between October 2005 and October 2007 stands out as his most profitable 24-month stretch of his entire trading career.
Wow.
So it really shows the power of technology and adapting to changing market dynamics.
Yeah, but Parker, as we've seen throughout this journey, is not one to just rest on his laurels.
Right.
He's not going to just sit back and, think that he's solved the market.
No, the market's always evolving.
Right.
And even the most successful traders have to constantly stay ahead of the curve.
So did he face any other challenges, or did he make any other adjustments to the system along the way?
He did. So in 2012, Parker actually ran into a bit of a roadblock. His system's short side, which had been performing really well, just started to underperform.
Mm-hmm.
And it was a wake-up call. It was a reminder that even the most robust systems can break down.
That's right. The market is dynamic.
When market conditions change, right?
Yeah. And what works in one period might not work in another.
Exactly.
This is a lesson for all traders to keep in mind.
For sure, especially for new traders. Just because something worked in the past doesn't mean it's always going to work.
So this led Parker down a new path, right?
It did, yeah. So he started to explore what are called mean reversion strategies.
Okay, and maybe for our viewers who aren't familiar with mean reversion, can you kind of explain how that works?
Sure. So mean reversion is this idea that prices have a tendency to revert back to their average over time.
Okay.
So think of it like a rubber band, right?
Yeah.
If you stretch a rubber band away from its resting point, eventually it's going to snap back.
Right.
So in trading, this means identifying assets that have moved significantly away from their average price
Okay.
and betting that they're eventually going to return to that average.
So instead of riding trends, like he was with his momentum system,
Right.
now he's trying to capture these rubber band trades, as you say.
Exactly. He's looking for those reversals to the mean.
That's interesting.
So he started testing different mean reversion parameters, looking for those sweet spots that would, give him consistent profits.
Interesting.
And he made a key distinction. He found that long mean reversion trades, where you buy an asset that's dropped below its mean, were more profitable than short mean reversion trades.
Interesting.
Where you're selling an asset that's gone way above its average.
So constantly challenging his assumptions, always testing, always tweaking.
Always experimenting.
Right. But did it ever backfire? Did he ever go down a rabbit hole that led to losses?
He did. And, this pursuit of improvement, it did come with a cost.
Oh.
In 2015, he actually experienced the most significant drawdown of his entire trading career.
Wow.
Which was a painful but valuable lesson in the perils of what's called over-optimization.
Okay, break that down for our viewers. What is over-optimization and how did it lead to this big setback?
Yeah, so over-optimization is this trap that I think a lot of traders fall into.
Okay.
And it happens when you tweak your system's parameters to get, amazing performance in your backtests.
Okay.
But those parameters are so finely attuned to the historical data that when you actually go to trade it in the real market, it just completely falls apart.
It doesn't work.
It doesn't work.
Because the market's not the same as it was.
Right. It's brittle. It doesn't have that robustness to adapt to new market conditions.
It's like building a race car,
Right.
perfect for a perfectly smooth track. Yeah. But the minute you hit a bump or a turn, the whole thing falls apart.
Exactly. That's a great analogy.
Yeah.
And so in Parker's case, he had gotten so reliant on his mean reversion strategies.
Okay.
He allocated a big chunk of his capital to them.
Okay.
And when those strategies underperformed in 2015, the losses were pretty substantial.
This must have been devastating. I mean, just both financially and emotionally.
It really was a turning point for him.
Yeah.
It forced him to really, confront some hard truths about his approach.
So how did he recover? Did he abandon mean reversion altogether, or did he find a way to salvage those strategies?
Yeah, that's a great question, and we'll dive into that in the final part of our deep dive. So, where we left off, Parker had experienced this really significant drawdown.
Yeah, from over-optimizing the mean reversion stuff.
Right, and it was a tough time for him, but, it really forced him to take a step back and reevaluate his whole approach to trading.
It sounds like a turning point.
Yeah, it was, and he realized that, chasing these perfect backtest results was kind of a fool's errand.
Yeah, because it leads to those brittle systems, right?
Right, exactly. You can make a system look amazing in a backtest, but then when you actually put it to the test in the real market,
it falls apart.
It just completely crumbles.
Yeah, because the market's not the same as it was in the past.
Right, and it's not going to be the same in the future either.
So instead of trying to predict every market move, it sounds like he was more focused on building systems that could handle anything. Right.
Yeah, systems that were robust, that could weather any storm.
So this experience made him more risk aware, would you say?
Absolutely. I mean, one of the biggest changes he made was introducing what he called a system stop rule, which basically meant automatically deactivating a system if it lost a certain percentage from its peak.
So like a circuit breaker.
Exactly, like a circuit breaker.
Yeah.
And that really helped him preserve capital, during drawdowns, and it prevented him from getting too attached to underperforming systems.
It's almost like cutting your losses short and protecting yourself.
Right. Recognizing that no system is perfect.
Yeah.
And sometimes you just need to step away.
So besides that, what other lessons did he learn from this experience? Did it change the way he built systems?
Yeah, I think this experience really forced him to embrace simplicity.
Okay.
He realized that complex systems with all these bells and whistles, they're often more prone to over-optimization and failure.
Yeah, they look good on paper, but...
Yeah, they look good in backtests, but they don't necessarily work in the real world.
Right.
And he also became much more disciplined about his position sizing.
Okay.
Making sure he wasn't risking too much on any single trade.
So moving away from complexity, focusing more on what really matters, the core stuff.
Right, focusing on those core principles.
Yeah, it sounds like this setback ultimately made him a stronger, a more resilient trader in the long run.
Yeah, I think it definitely did, and it really speaks to his character.
Yeah.
He didn't let this defeat him.
Yeah.
He used it as an opportunity to improve and refine his strategies.
So what did he focus on after kind of this reset? What new strategies or markets piqued his interest?
So he still stuck to his core principles of systematic trading, data-driven decision-making,
Yeah.
and rigorous risk management.
Okay.
But he started to apply them to new areas. He became really interested in IPOs.
Oh, okay. So like the initial public offerings?
Yeah, yeah.
Okay.
He saw this as an area where there might be some unique opportunities.
That's an interesting niche.
Yeah, it is, and it's a challenging one, too.
Right.
But he also went back to his momentum strategies, focusing on identifying stocks that were showing relative strength,
Okay.
Trading above their 200-day moving average.
Right.
And this kind of aligned with his belief in riding trends,
Yeah.
catching those big moves.
That makes sense.
Yeah, so he was always, looking for those areas where he could apply his systematic approach and potentially gain an edge.
Yeah. So combining his core principles with these new ideas,
Exactly.
constantly adapting and evolving to stay ahead of the market.
Always looking for an edge.
And this is really a key takeaway for all traders,
I think so, too.
isn't it? That the market is always changing.
Right.
And to be successful, you have to be able to adapt.
And that willingness to adapt is what separates the good traders from the great traders.
Well, this deep dive into the world of Marsten Parker has been incredible. We've seen his journey from a classically trained musician to a systematic trading master,
It's an amazing story.
overcoming both challenges and setbacks.
Absolutely.
And it really highlights, I think, what's so important about trading.
For sure.
It's not about finding that magic formula.
Right.
It's about developing a deep understanding of the markets,
Yeah.
managing risk effectively, and always seeking out ways to improve.
Right. It's a continuous journey of
Yeah.
learning and adaptation.
That's right. And I think Parker's story shows that, embracing simplicity, focusing on what matters,
Absolutely.
and never losing that spirit of experimentation and continuous learning are key.
Those are the keys to success in the markets.
Well, that's it for our deep dive into Marsten Parker. Be sure to check out the comments section below and let us know what resonated most with you about Parker's approach